Hey folks, happy Monday. Um, this is it. We're in week 8, my final week with you. And in honor of that, decided to do a little aloha for you. I hope you're all doing well. I'm really excited for this week. Now we will still be working together, obviously. And so uh, we'll still go over your career stuff and I'll still be available for you for questions on your case study, but this will be our last chapter together. Starting next week, you'll be working with Mike Lee on information systems, and he is amazing. So I'm really excited for you to experience that. So this week, we're going to talk about mastering financial management. And in conjunction with this, on Wednesday, we're going to look at personal credit. And we talked about that, how to establish good credit, bad credit based on your goals, okay? Just like we do here in corporate finance. So let's just jump right in. And so why the need for financial management? Basically, financial management is all the activities concerned with obtaining money and using it effectively. You know, how do we obtain cash? Whether it's through sales or whether it's through loans or whether it's through stock. And then how do we manage that process of using that cash? And that's where our budgets come in. We set yearly budgets, quarterly budgets, and then we look to achieve the requirements of that budget. And so proper financial management must ensure that funds are available when needed, both now and in the future. Okay. Financing priorities are established in line with overall organizational goals. Everything we do, just like in our own personal lives, is set by the goals that we've established for ourselves and then our companies. Spending is planned and controlled, and that's where that budget process comes in. And for many of you finance students who move into corporate finance, that's going to be a big part of your role, is helping managers in different departments understand the budgeting process and then helping them establish an effective budget to hit their goals. A firm's credit customers pay their bills, so that's we extend credit to a customer. We need to make sure that they're paying that on a timely basis. Okay, bills are paid promptly. The funds required for paying the firm's taxes are available. That's most important. And then excessive cash is invested in certificates, CDs, government securities, conservative marketable securities. So this is just like you're going to do in your own lives, right? Again, you set goals, you set a budget, you have your salary as your revenues, and that's how you're obtaining cash. And then we need to look at, as individuals, you know, how are we making sure that we have the money we need to pay our taxes at the end of the year. Make sure we are paying our bills in a timely manner. And then any excess cash, what are we doing with it? Are we just spending it or are we investing it? Okay. So you'll see a lot of similarities between how corporations run their finance departments and then how individuals run their private finances. Here's some different careers in finance. Typical jobs, CFO. Some of you did look up Sean Duffy over at Viasat, the current CFO there. I think it's now $3 million a year is what she's making. So that's not bad. VP of Finance, bank officers, consumer credit officer, financial analyst, financial planner, loan officer, insurance analyst, investment account executive. Managers and employees in the finance area must have a strong background in finance and accounting and know Excel. First and foremost, know Excel. Everything you do, every single manager that I talk to out in the world, all of them say, one, our students stand out because they know Excel well, and they only allow people to come in and work for them. They only look for incoming staff members who have extensive Excel skills. So it's really important that you understand that, and not just in finance or accounting. Every business position, you need to understand Excel, and you need to use Excel, and that's why we teach it. So, strong background in finance or accounting, and then you need to know Excel. And be an expert in written and oral communication. Remember, it's the finance people who take the information, right? The data, they take that data and they turn it into information to present to managers. Okay. And so you need to be able to effectively communicate that data or that information to your audience. Here you go. Comparison of short and long-term financing. So we'll get to those terms here in a second, but short-term financing needs, basically cash flow problems, current inventory needs. We've just taken on a bigger client, so we need to establish more inventory, and so we might need a short-term loan, or we might need short-term cash to increase our inventory. Short-term promotional needs, again, if we're marketing a new product, we might need cash to put together that marketing proposal, that marketing plan, and then initiate it. Speculative production, monthly expenses, and then unexpected emergencies. Again, just like in your home, it's always good to have some short-term financing. If you're you need a new roof, or your water heater goes out, or your brakes go out, or anything like that. Okay. Long-term financing needs, those are business startup costs, new product development, replacement of equipment, mergers and acquisitions, long-term marketing activities, and then expansion of facilities. All of those needs are gonna be much longer term processes, and thus they need longer term financing. Okay. Here's some examples. Short-term financing, money that will be used for 1 year or less. That's important to understand. Okay. In the quizzes, if you're super worried about that, that's the definition. Short-term financing is money that will be used for 1 year or less. Cash flow is the movement of money into and out of the organization. And I'm going to show you a cash flow statement here in a second. Speculative production, which was one of the things that you needed short-term financing for. That's the time lag between the actual production of goods and when the goods are sold. Okay. Long-term financing, money that will be used for longer than 1 year. So that's pretty easy. Short-term financing, again, is money that will be used for 1 year or less. Long-term financing, money that will be used for longer than 1 year. Just remember that. The risk-return ratio, a ratio based on the principle that a high-risk decision should generate higher financial returns. For a business, and more conservative decisions often generate lower returns. As investors right now, you're 18, 19, maybe 20 years old. You have the ability to take risks on your portfolio. You can do some riskier investments because you have time to recoup if there's a loss. And if you hit the home run on that risky investment, then you should and you will get a higher return. That's just the way it works. Now, as you get older, such as my situation, my portfolio is much more conservative, right? I'm much more in mutual funds. I'm much more in, S&P stocks. And so we want to make sure that because I'm closer to retirement, that I'm not taking too great a risk. Because if I did and I lost out, my retirement could get pushed back. So the risk return ratio just states that the greater the risk should be the higher return. The conservative the risk, you're going to get a lower return. Okay. The 3 steps of financial planning. First and foremost, and again, this is going to mirror what you do as an individual. You establish your goals and objectives. What do you want to get accomplished? Then you budget the money needed to accomplish those goals and objectives. And then you identify the source of funds. If it's sales revenue, if it's equity capital, money from a sole proprietor, so more investment, whether you're selling common or preferred stock, short-term borrowing, a long-term borrowing. This is debt. This is leverage. This is when I talked last week about the debt to equity ratio. Are we borrowing more than we're investing? Okay. And then sales of assets. You could have a big piece of machinery and you've used it to the life that it was meant to be used. Okay, so you've depreciated it over the lifetime of the asset, and then you wind up selling it, right? So you still sell it, and then you can move that back into cash that you have. Then what you're going to do, as any whether it's managerial decision making, whether it's anything, you're going to then look, monitor, and evaluate. So when you're doing a budget, you're going to, again, establish those goals, set the budget, figure out where your money's coming from, and then also where it's going to, and then monitor and evaluate. And it's just a continuous loop, like every other thing in business. You have to continue to monitor. You have to continue to evaluate. Are they the wrong goals? Are they wrong objectives? Have you budgeted enough money or too much money? Okay. So a lot of times when you get a yearly budget, you'll come back every quarter, potentially even every month, depending on what the market looks like. And then you'll reevaluate. Okay, did I really budget enough money? Was I too cautious in that budget, or was I too aggressive with that budget? And so you just want to make sure that you're evaluating. A budget, and that's a financial statement that projects income, expenditures, or both over a specified future period. So a yearly budget will have typically two components: revenues, right? Sales revenues or cash in, and then cash out. And that cash out could be, salaries, accounts payables, office expenses, any of that stuff. And at the end of every month, you look at that and go, okay, did I hit my sales budget? I've set a number I have to hit. Did I hit it? Okay, I did. Great. Did I hit my expense budget? Oh no, I went over on expenses. Okay, well, we need to reevaluate that. Am I spending too much money? Okay. Each month you really want to look at that. And then every quarter you want to look at that, because you could have one really good month and then the next month not so good. And then the next month really good. Okay. So then you did on a quarterly basis. One month you missed, but on a quarterly basis you hit it. Okay. And then what does it look like at the end of the year? Okay. And then a cash budget is a financial statement that estimates the cash receipts and cash expenditures for a specific period, strictly dealing with cash. Here's what a cash budget looks like, right? So you've got cash sales and collections, first quarter, second quarter, third quarter, fourth quarter total, less payments. So here are your expenses, okay? And then as you can see here, in this quarter, because of the parentheses, you lost $7,000, okay? In the second quarter here, you made $38,000. And then you made $8,000, and then you made $67,000 for a total of $106,000 for the year, okay? So you had cash sales and collections of $645,000. Here are all your expenses, okay? And at the end, here's your cash gain or loss, right? So you look at it quarter over quarter, most of the times month over month, and then year over year. And then you continue to adjust when needed. Traditional banking services for business clients, short-term business loans, they must be repaid within 1 year or less. They help ensure that short-term money will be available, and we talked a lot about that. An LOC, or a line of credit, is a loan that is approved before the money is actually needed. So I may establish a line of credit. Even as an individual, you may establish a line of credit based on the equity you have in your home. And when you need to do something, you need to do home improvements, you take out money on that line of credit, and then you do your home, and then you pay it off. Same with the business. We establish a line of credit. Maybe we need to take some short-term money to do a new marketing campaign. You do it, then you pay it back. Okay. And then a revolving credit agreement is a guaranteed line of credit that a bank will extend its customers. Long-term business loans, they're paid off over a period of years. Most of them require collateral. Okay. So either real estate, property pledged is securing the loan. Anything long-term, again, if you think about when you buy a home or you buy a car, that's a longer-term loan. And what's going to happen is you're going to need to provide collateral. And most of the times that collateral is going to be either the car that you're borrowing on or the home that you're borrowing on. Okay. So there's a lot of similarities here between how you manage your loans or will be managing your loans and how companies do it. Okay. Credit card transactions. This is kind of scary. A recent Gallup poll found that 3 out of 4 Americans, 76% have at least one credit card. And actually, on average, Americans have 3.4 credit cards. And half of Americans, 48%, are carrying credit card debt from one month to the next because they don't pay their entire credit card debt each month. This comes back to just in general, most companies, most people are over leveraged. And it's because credit rates have been so low. Interest rates are so low, people are borrowing more. And that's just a reality. And so what's happening is people are, again, that debt to equity ratio is growing higher and higher and higher. It was funny. I'm refinancing my house right now, getting below a 3% interest rate. And the guy goes, wow, your debt to equity ratio looks really good. And I had to thank him. I was like, wow, that's great. I talk about that all the time as an important factor in lending. And if I'm going to invest in a company, if I'm going to lend a company money, if I'm going to lend a person money, the thing I look at is their debt to equity. Okay. So it's super important that you look at that. And it's super important. And this is why I'm going to talk about this on Wednesday, establishing good credit versus bad credit and how to do that. Sources of unsecured short-term financing. So short-term debt financing is usually easier to obtain than long-term debt financing for 3 reasons, right? Shorter repayment, less risk for the lender, right? If it's a shorter repayment plan, there's less risk. You're borrowing less money, so we're not risking as much. Again, smaller dollar amounts. And then finally, relationship between the banker and the company. Most of the times, even though it is kind of, we've kind of moved out of that space now, where there's a relationship, a personal relationship between a banker and a company, it still does exist. There are banks out there that have small business customers, and those small business customers often come in and use full banking services, including lending. And so those still are there, but that was much more prevalent back in the day when you went as a small business or even a big business and you established these long-term personal relationships with your banker. And then when you needed money, they not only could count on your debt to equity ratio, they could count on, collateral, they could also count on your relationship. And that was big. Okay. Most lenders do not require collateral for short-term financing. Okay. That's called unsecured financing. Sources of secured short-term financing. So loans secured by inventory. Those are finished goods, raw materials, and work in progress inventories may pledge as collateral for short-term loans if you need it. Loans secured by receivables. So your AR or your accounts receivable amounts owed to a firm by its customers, and a firm can pledge its AR as collateral to obtain short-term financing. Factoring. This is a big business right here. There's companies here in San Diego. There's companies all over California, all over the country that basically specialize in factoring. And what a factor is a firm that specializes in buying other firms' accounts receivable. So if I've got accounts receivable debt, a lot of it, then sometimes it's easier for me as a business to sell that debt for maybe, 50 cents on the dollar. So I'll take half of my money. Okay. So if you think about it, so if I produce a pencil, it costs me 10 cents maybe to make this one pencil, but I'm going to sell it for 50 cents. Okay. And so what happens if I sell it for 50 cents, and then I build up enough accounts receivable, then it's almost worth it to me if I sell a lot of these pencils to a company and I sell it on credit and I've got accounts receivable from them. It maybe makes sense for me to sell it for half of what it's worth, so 50 cents on the dollar, to a factoring company, because then I'm still going to make profit. on these pencils because I'm making them so cheap and I'm selling them. My markup on them is so high. So a lot of times companies like, a lot of clothing companies, one of them I used to work with Billabong a lot. It's one of my clients, and their VP of credit and collections, he would often just say, we sell our clothing at such a high margin. Sometimes it makes sense for us just to sell off our debt, our accounts receivable, right? The money that Nordstrom's owes us or other surf shops owe us. It makes more sense for us to just sell that to a factor for half price. Say if we have $1 million in accounts receivable, we'll take 500,000, and then the factor, it's up to them to go then collect that money. Okay? So the factor buys the accounts receivable for less than their face value. However, it collects the full face value dollar amount when each account is due. And then the factor's profit is the difference between the face value of the accounts receivable and the amount the factor paid for. So there's companies out there that buy hospital debt, right? Healthcare debt. They buy credit card debt. They buy auto loan debt. And then they turn around and then they go out and collect it. And the companies that initially establish that credit or establish that debt, they're going to get as much as they can out of it. Sometimes it's even 10 cents on the dollar, right? And so whatever they can get about. But there's companies, that's all they do. They buy debt and then they go collect it. Okay? And that's risky. But they make a lot of money if they can collect that debt. Or if they can even collect a percentage of it, they're still going to make a lot of money. Comparison of short-term financing methods. Here it is. Right? Trade credit, low cost, repaid within 30 to 60 days. Businesses that may use it, all businesses with good credit, and then there's usually no finance charge. Promissory note issued to suppliers. There's moderate costs, again, less than a year. All businesses use it, usually unsecured, but requires legal document. And then unsecured bank loan, moderate costs, so whatever interest rates are, you pay again. All these are less than 1 year. All businesses typically can get an unsecured bank loan. And then there's a promissory note is required and compensating balance may be required. Commercial paper, typical repayment is 270 days or less. Large corporations with high credit, usually available only to larger firms. Secured loan, same thing, except now it could be secured by collateral or accounts receivable. And then factoring is another way of getting short-term financing. Okay. Cost is high, repayments none, there's no repayment, and then you get the accounts receivable sold to the factor. And then it's firms that have a large number of credit customers. Again, a lot of clothing manufacturers, a lot of drug manufacturers, think about all the companies that sell, a lot of devices, phone companies, computer companies. Selling stock. Okay, so an IPO, our initial public offering, and the primary market. An IPO occurs when a corporation sells common stock to the general public for the first time. Okay, think about, when Facebook went public or when Spotify went public. Those were two of the largest IPOs ever in recorded history. Okay, you can look those up on Yahoo Finance or Google. Okay, when a corporation uses an IPO to raise capital or raise money, capital is money, the stock is sold in the primary market. Okay, the primary market is a market in which an investor purchases financial securities directly from the issuer of those securities. Okay, and what will happen most of the time, actually all the time, a company will enlist the use of an investment bank to help them with the IPO. And basically an IB is an organization that assists corporations in raising funds, usually by helping to sell new issues of stocks, bonds, and other investments. Goldman Sachs is probably one of the most recognizable investment banks in the world. Okay, initial public offering in the primary market. The advantages of selling stock. Here they are. There's no repayment obligation. I sell you the stock, and you buy the stock in hopes of a return on your investment when you resell it, right? You're giving me money as a partial owner in my company, and then I just keep the money, right? and I don't have to pay you a dividend. So if my company goes bankrupt or if my company goes out of business, you could potentially lose all the money you invested. I've done it. I've lost money on investments, and that's just what happens. It's a risk we take. Okay. So the secondary market. The secondary market is a market for existing financial securities that are traded between investors. Okay. So the IPO in the primary market, the secondary market is the, NASDAQ, the New York Stock Exchange. Those are companies that are already selling stock. And those aren't the companies. It's the people like myself or my broker who's buying and selling the stock and investing their clients' monies, right? So a secondary market is a market for existing financial securities that are traded between investors. Again, Coca-Cola, IBM, Apple, all these companies are out there selling on the secondary market. They are not selling. Their stock is being sold on the secondary market by investors. So again, if I have stock in Apple, I could ask my broker to go out and sell that stock for me, and they're going to sell it on the secondary market. So usually a secondary market transactions are completed through a securities exchange, such as the NYSE or the NASDAQ, or over the counter. Important to know these two, okay? Common stock whose owners may vote on corporate matters, but whose claim on profits and assets are subordinate to the claims of others. So if I'm a common stockholder, yes, I get to vote, even though most of the time most common stockholders don't vote because they don't want to take the time. So common stockholders have the right to vote. Preferred stock owners do not have the right to vote, but whose claims on dividends and assets are paid before those of common stock owners. So if a company goes bankrupt, so again, a company like Enron, they go bankrupt, the common stockholders, they are out. And unfortunately, most of the people who worked for Enron and had their money invested in Enron were common stockholders. So they didn't get anything. The preferred stockholders, which are typically management, right, leadership, they get their money back after other debts are paid to banks and to, fines and anything like that. So when all the money whatever money's left over after paying all your debts and doing all that, the preferred stockholders get the money before the common stockholders, okay? But the common stockholders do have the right to vote on any corporate matters. Retained earnings, that's just a portion of a corporation's profits not distributed to stockholders. So if a company makes, $100,000 or $100 million at the end of the year, sometimes companies will send out dividends. If they don't do that or whatever's left over, they call those retained earnings and they invest them back into the company. Venture capital, angel investors, and private placement. So venture capitalists or venture capital money, that's money that's invested in small and sometimes struggling firms that have the potential to become very successful. So you'll have VC companies, they're investing money into small companies. Angel investors, those are investors who provide financial backing for small businesses, startups, or entrepreneurs. What I want you to think about VC and angel investors, think Shark Tank, okay? A lot of times, though, angel investors don't ask for money back. They're doing this because maybe, you have somebody who's invented a new way to clean up the ocean, right? Or do away with plastic one-use water bottles. And so that angel investor may say, hey, it's worth it. I'm going to invest $1 million in this company, in this nonprofit, because they're doing good and it's a cause that I believe in. I'm a billionaire. And so I can afford to throw $1 million out there and I don't expect any return. I'm doing this, just out of my own good faith. Where a venture capital company will invest in the company, but they expect a return on their investment. So a company like Tipsy Elves, which was on Shark Tank, that's a company that makes ugly Christmas sweaters and other stuff. I believe Mark Cuban invested in that company. And so he gave them $100,000 to startup seed money. And then what they did is they gave him, 5% of the profits. And so that's what a venture capital. So think Shark Tank. Private placement occurs when stock and other corporate securities are sold directly to insurance companies, pension funds, or large institutional investors or mutual funds. Like a company like a Vanguard or Mutual of Omaha or something like that. Sources of long-term debt. So financial leverage, the use of borrowed funds to increase the return on owners' equities. This is what we talk about when we talk about leveraging. The principle of leveraging works as long as a firm's earnings are larger than the interest charged for the borrowed money. So if I borrow money and I'm paying a certain amount of interest, which now is so low, so a lot of companies are borrowing money because it makes sense, because the interest they're paying is just nothing compared to the money that they're getting from that investment. So they take that investment, they borrow $1 million to build a new factory. Their interest rate is 2%. Their payoff or their interest paid is nothing compared to the money that they're going to make on that new factory. And so that's why it's really important to understand, not to be over leveraged, because if you borrow too much money and then don't have a way to pay it back, or you're not making as much money as it's costing you for the loan, it doesn't make sense. Okay. For small business, long-term debt financing is generally limited to loans, whereas large corporations can, issue corporate bonds as well. And actually, it's funny, many of the corporate bonds, a GE corporate bond is worth more and much more secure than even a U.S. security, a T-bill, because GE's a better run company than the United States, and they're carrying less debt. Long-term loans, those are, again, loans that are paid out over a number of years. Typically require a promissory note that requires a borrower to repay a loan in monthly, quarterly, or semi-annually installments. The lender usually requires some sort of collateral, and then the lender may also require that borrowers maintain a minimum working amount of capital. Corporate bonds, here we go. A corporate bond is a corporation's written pledge that it will repay a specific amount of money with interest. Interest rates for corporate bonds may vary within the financial health of the company issuing the bond. So again, you buy a $100 corporate bond, they're going to say, okay, we're going to pay you 10% plus the original bond amount. So I should get $110, okay? And so at the end, whatever the lifetime of the bond is, if it's a 5-year bond, I buy a $100 bond and they're guaranteeing me a 10% return. After 5 years, I should get $100 plus $10. Okay. Now, most people buy more than one bond. They'll buy multiple bonds from multiple companies. And it's just another way to invest. Okay. So most corporate bonds are registered bonds. A bond registered in the owner's name by the issuing company is a registered bond. And then that maturity date is what I talked about, the date on which a corporation is to repay the borrowed money. And most of the times, if a company needs to, if they're doing something really big, if they're again, entering into a new market overseas and they need to build a big facility, they'll usually sell bonds to generate that capital. Here we go. Again, the risk return ratio for corporate bond investors. High quality corporate bonds pay less. So again, a GE bond is not going to pay that much. So less risk, the bonds with less risk have lower interest rates. The more risk, the bonds are going to be higher interest rates, but a lot of times those are junk bonds. So they say, yeah, give us $100, we'll give you a 20% return. But is that really, are you really going to get that money, or are they going to go bankrupt? Or are they going to take the money and do something else with it? So just a lot of things to think about when you're investing in bonds. The comparison of long-term versus, we already went through short-term, but the comparison of long-term financing methods. Again, selling stock, either common or preferred. There's no repayment. There's no repayment period. You don't have to pay dividends. All corporations that sell stock to investors, that's common stock. Typically, preferred stock is only large corporations that have an established investor base of common stockholders. And then long-term loans, yes, there's repayment, usually 3 to 7 years. Again, kind of like a car loan. Interest rates between 3 and 12%. Nowadays, it's probably not going to 12%. And then all firms that can meet the lender's repayment and collateral requirements. So those are the companies that can use it. And then a corporate bond, yes, there's repayment, usually 1 to 30 years. The interest rates are between 3.5 and 10%, depending on the financial stability of the company. So the risk, and then it's typically large corporations that are financially healthy that issue corporate bonds. Again, a company like GE or Coca-Cola or IBM, they issue corporate bonds, and usually you're going to get your money back. Probably more so than with the federal government. And that's it. We are done with week 8. Again, this is one of my favorite lectures. I love talking about finance. I love talking about just how people and companies, how they obtain cash, how they invest that cash, how they pay debt. And so it's really something that you should all look at potentially as finance careers, but also as business owners. As business owners, you're going to have to understand this, and you're going to have to deal with a lot of this, whether you're working for, whether you're owning a big company or a small company. This is important to understand. And then as an individual, like I said on Wednesday, we're going to specifically talk about credit card debt. We're going to talk about student loan debt, how to establish good credit versus bad credit. Okay? So have a great day. Really appreciate you all so much. And I will see you on Wednesday. Let me know if you have any questions. Bye.